What's up, guys? Keep it down because it's the wee hours of the morning and not everyone in my house is awake right now. So forgive me for that. But you can see, yeah, Bitcoin it is pushing up before the funds rate. Not long now. A few fun little GIFs. GIFs. Up in the bottom left to distract everyone. I'll skip going on camera for now. We'll just use this. Anyway, I'm gonna go make a coffee. I'll let the music play and just let the chart do its thing. It's still a number of minutes before we get there. 35 minutes, 36 minutes. Plenty of time for me. All right. I'll be back. Right, I'm back. I've got my coffee. That took a long time. Sorry about that. Just adjust these levels a little. Okay. Now, hopefully, with any luck, my internet stays connected for the next hour. But yeah, we'll just play it by ear. If it does drop out, I should be back up online within 15 minutes, within 10 minutes kind of thing. But yeah, looking good for now. Serrano's in the chat, DC Woodworking, relaxing sounds. Good afternoon to you all. Lex, how you doing? Wolverine. Yes, it's the forecast is 50 basis point. So here's the Forex Factory. This will tell us like what the funds rate target or what the forecast is. So this will be the interest rate. If we get a 50 basis point hike, it'd be 4.5% because interest rate is currently sitting at 4%. So a 50 basis point hike, of course, putting it at 4.5. Now, if we get, I mean, I think it's extremely unlikely that we get a 4.75, so a 75 basis point hike, but there's always that sort of air of possibility, But yeah, it's likely to be 4.5. They don't really get these wrong with the interest rate decisions. See, 0.5 as forecast, 1-to-1, 2.5 to 2.5, 3.25. You get the picture. The only one that was off target here was the hike from 1 to 1.75 on June 16. That caught everyone off guard. June 16. Can we remember when that was? Here, look. It was during this collapse. So things were looking bad at the time for Bitcoin anyway. And then we got that really nasty interest rate hike at this, to push it down even further. So had we not have gotten that hike, price perhaps may have pulled up, at say 22k or 21k for that matter, because I think there's a wick down here the day before. Okay. Maybe, okay, yeah, no, maybe 20, sorry. That may have been the floor, but because of that bad interest rate hike, or that heavy hike that we had, we fell that extra length down. We fell a further $2,000 down and got our June low of 17,622. So let's delete all these squiggles. And let's focus in on the here and now. So there's not long to go now. There's 11 minutes until the FOMC meeting starts. I might try and see if I can find like a live feed of that. Maybe CNBC has like a stream of it going. Bear with me, I'll try and find one. Yahoo Finance upcoming. Okay, that starts at 5:30 a.m. Alright, I think I've been talking for the last 10 minutes and no one's heard me. Whoops, that's my fault. Let me go back to the minute chart here. Okay. So funds rate, yellow line, down on the minute chart, seeing the short-term price action here. I didn't say anything that crazy. We've got the funds rate decision on the right here, so we'll get these little refresh buttons very soon. I'll keep refreshing this page to find when we get them. Oh, there's one, funds rate decision button. So I'll keep pressing this. Our forecast is 4.5. Previous has been 4. So that would be a forecast of a 50 basis point hike. Unlikely. It would be unlikely if we get a 75 basis point hike, but you know, never say never. What I was talking about earlier was the fact that, you know, pretty much all this year, the forecasts have been on point. They've been on point with what actually comes out as the result. So, yeah, very likely to get the 50 basis point hike this time. Now, the interesting thing will be if it does come out as expected, as forecast, what does that do to the price? Like, is it a good thing? Is it a pumping thing if it comes in at a 50 basis point hike, or is it business as usual, like can carry on, you know, chopping sideways? Like, yeah, I guess we'll have to wait and see. Not long to wait, 6 minutes. So let me catch up with some of these comments down here. Federal Reserve go live. Okay, thanks, man. I'm gonna open that up. Fomc press conference. So that's it. Okay, that's at 5:30. Yep. So that'll be half an hour after the funds rate decision comes out. But still very interesting to listen to that. I'll play it live. I don't think it's copyrighted because it's a government broadcast. So it should be safe to play that without getting demonetized. I believe my channel. See if there's any like warm-up music. Oh yeah. You know, something I was thinking of doing was getting an aggregator in the background, just so we can hear those orders coming through, being filled on Bitcoin. But yeah, I certainly don't want to annoy anyone with that sound because it can get pretty loud. Let's see if we can find it. There we go. So that's the aggregator there. See if you can do this. Would you look at that? No, I'm not muted. Bro. Oh, the pop out. Yeah, sorry, that's a good idea. My bad. Oh, Serrano, your reaction. Oh, shit. That's a nice little taste. What we got? We got 3 minutes? No result just yet. I'd love to make this like this. Load the CPI figures in there, I guess. Bit of an old dump. Ooh, look at that. Let me hide this. Wow, what did it come out as? That is a serious dump. Whoa. The result hasn't come out yet. There's still a minute to go. The market likes it though. The market's very excited. And it's gone. See, this is why it can be very, very dangerous trading these events, huh? Let me know if you want me to turn this down. The audio might be a bit loud. Oh, okay, yeah. Let me do that. Is that better? That might be better. Yeah, it's gonna get loud. Ooh, okay, I think the rate decision came out. 4.5! Hey, it's as expected. Here we go, let's rock it. Serrano doesn't like the binging, so we better keep him happy. No problems. Well, there you go. There's the chaos. We got our result. It's pretty much what we were expecting, hey? A big old 4.5%, 50 basis point hike. It's still an increase. It's a raise to interest rates still. It's a bit of a sell the news event, I think. Well, at least for now. It's been like a big old sell the news. Buy the rumor. See, if it came in grossly lower than expected, then maybe that would have had an opposite effect. Like a pump instead of like a sell-off. I don't know, it's still early. We could see it rise up. We've still got the actual meeting to take place in half an hour, so we'll see what he says. I think he's going to say some positive things about inflation, the fact that it's coming down, the fact that we pulled in a 7.1%, and you know what he's going to say still. He's going to keep it real. He's going to be like, we've still got work to do. We're still a ways away from our target of 2% inflation, but we're heading in the right direction. Something to that effect, I think. I think that's what he's going to say. Monetary policy PDF. I'm going to open this up. Let's Let's see if I can make this dark. No, can't. Let me read this out. What's the DXY is pumped. Ooh, off this rate decision, of course. Futures, S&P futures is dropping. Don't worry about GME. We're interested in Bitcoin. And look at that. We've popped back down under 18K. Blue line is our June low. So we'll see where that ends up. All right, I'll read this out. This is the Federal Reserve press release. For release at 2 p.m. Oh yeah, people can get it in the Discord. Okay, no worries. Well, I'm going to read it out for those that can't be bothered to watch it or read it or listen to it or whatever. Recent indicators point to modest growth in spending and production. Job gains have been robust in recent months and the unemployment rate has remained low. Inflation remains elevated, reflecting supply and demand imbalances related to the pandemic, higher food and energy prices, and broader price pressures. Russia's war against Ukraine is causing tremendous human and economic hardship. The war and related events are contributing to upward pressure on inflation and are weighing on global economic activity. The committee is highly attentive to inflation risks. The committee seeks to achieve maximum employment and inflation at the rate of 2% over the longer run. In support of these goals, the committee decided to raise the target range for the federal funds rate to 4.25% to 4.5%. Okay, the committee decided to raise the target range for the federal funds rate to 4.25% to 4.5%. The committee anticipates that ongoing increases in the target range will be appropriate in order to attain a stance of monetary policy that is sufficiently restrictive to return inflation to 2% over time. In determining the pace of future increases in the target range, the committee will take into account the cumulative tightening of monetary policy, the lags with which monetary policy affects economic activity and inflation, and economic and financial developments. In addition, the committee will continue reducing its holding of Treasury securities and agency debt and agency mortgage-backed securities, as described in the plans for reducing the size of the Federal Reserve's balance sheet that were issued in May. The committee is strongly committed to returning inflation to its 2% objective. Now I'm going to open up a chart that has the interest rate month over month. Sorry, this is the year over year interest rate. So you can see we've definitely hit a peak of 9.1% inflation, and ever since then we've been on our way down, with the most recent year over year inflation figure coming in at 7.1. So we'll have to wait until January to get the next reading. Hopefully that is down. Inflation obviously still high. Here's the target that the FOMC are talking about. Just highlight that white, make it a little thicker. That is the 2% inflation target. You can see in the last decade, so what's this, 2010, 13, 14, 15, 16, 17, 18, 19, 20, yep, so that's a decade. That is the 2010s. You can see inflation was stable relatively. You know, there was still ups and downs, but for the most part, that's a pretty stable rate of inflation, which is what they target. That's, you know, that's them doing their job. Now, previous decade, so the 2000s, we all know the GFC hit real hard. So we had this crazy activity at the very end of the decade there. But yeah, for the most part, yeah, it was erring on the higher side for that whole decade. The 90s, you know, the 90s started off with a crazy spike. We were up at, I mean, nowhere near where we are now, but this is a 6.31% spike in the early 90s, but that got under control. And, you know, we saw it. It took it, you know, you can see it actually sometimes takes time to get it under control, like a number of years, perhaps even. But at least the initial spike, I mean, look at this. This is the 80s, the early 80s. Inflation was up here at around 14.8%. And it took all of 80, all of 81, all of 82 into mid to late 1983 to get it all the way down here. So that's a fair time to get that down. But you know, mind you, they had a pretty nasty starting point. I mean, they were up at 14.8%. The 70s, what a rough decade the 70s was. Look at that. Massive spike, and then a nastier spike at the end of the decade. Crazy. 60s, not so bad. I mean, it started, you know, relatively quiet, and then, you know, then we started getting hints at the inflation coming up. Crazy. The World War II, around this area. Going back further, here's the Depression, the Great Depression. What is it? 29 to 30 something. Yeah. So it was in like a bit of a deflationary period. I don't know if they had quantitative easing back then. I'm not sure. I don't know how they pulled themselves out of the Depression. Like, did they wait for it to naturally correct itself? I don't know. I don't have any idea of how that happened, but anyway, the data goes all the way back to 1914. December 1914. That's a lot of data on inflation. So you can see, comparatively speaking, when it's you know, inflation got high, but if we're to turn around from here, like, it's, you know, it's the highest inflation we've had since the early 80s. So it's been a good, you know, 40 years since inflation was up this high. But hey, look, we've turned a corner, it seems. It seems, you know, that seems like a pretty obvious sign that we've turned a corner and that inflation's on its way back down. So if you're looking for a reason why Bitcoin and crypto in general, and even the stock market, has been going down all year, here's your answer. That is why. That is the primary reason. But, you know, we've got a hint here that things are turning around for the better, and that we are coming back down to the Federal Reserve's target of 2%. It might take some time. If we continue on this trajectory, let's sort of do a little bit of a hypothetical forecast here. So if we continue on this path, roughly like that, that brings us to inflation hitting 2% on the 1st of October 2023. So yeah, less than a year. But hey, that would be a very positive, you know, no hiccups along the way. See, look, in this one there was a hiccup here, so we sort of went backwards, but then came down. But the important thing was, once you get your peak, it seems to be that once you get your peak in, you know, history shows that it does pull right back. And that's probably due to the Federal Reserve staying hawkish with their interest rate decision. So it's there for a reason. They don't hike it for fun. they hike it to get inflation back under control. Because we definitely don't want hyperinflation. That would be horrible. Your currency would be debased. And then everyone would have to turn to Bitcoin. Anyway. At least we know there's a back door. There's always a plan B, right? They call it the plan B Bitcoin. The Fed was created in like 1913. Oh, interesting. Interesting. Would you look at that? All right, let's get rid of this aggregator. We don't need this anymore because we've got our result. So we've got a 4.5% as expected, no problems. No surprises, which is good. We don't want any nasty surprises. So all is good. Little bit of, you know, exciting. Like over what do you call this? Like over enthusiasm to the funds rate decision. You know, pump for the sake of it. The real kicker was the CPI coming out. You know, that was awesome to see that come in. CPI is the that's the real party starter. Funds rate, yeah, it's still okay, but yeah, the real ones to look forward to are those CPI releases. Speaking of, let's actually find out when the next one is, just for argument's sake here. So it'll be sometime early to mid-January. So there's PPI on the 18th of Jan. Oh, okay, 12th of January. It's not even that far away. There you go. Less than a month away, we get the next CPI figures. So not even 2 weeks into the new year, we'll get a late Christmas present there. There's a few other like critical events that happen early next year, which is not far away. Do we have anything else coming up this year? Not really. Core PCE price index on the 23rd of December. The Christmas period until New Year is quiet. There's nothing critical happening. So that's cool. CB consumer confidence, not computer confidence. Flash services PMI. Retail sales. Yeah. There we go. That's pretty much it. This is pretty much the last high impact, you know, that really matters to a large degree event for the year. And then, you know, 2 weeks into next year, which is not far away, we've got that next CPI. Now the next rate decision, I don't know if we get one in January. So let's keep scrolling through. There's January. That's all of January. Okay, here we go. Funds rate on the 2nd of Feb. So there's no interest rate change through January. It'll stay at 4.5%. You heard it here first. So yeah, you can see pretty much the track record for how the rates decision comes in is usually as forecast, apart from this June 16 result. That came in higher than expected. They hiked by 75 basis points when we were only expecting a 50. So that was a nasty little kick down on the rate decision. Anyway, enough about that. Let's get back to the charts. Let's check it out. The dollar index had a nice little push there off that rate decision. We've got ourselves a new low, so we may as well move this line somewhere like that. Let's just zoom in to get the exact. Yeah, that's the point. That is the price to beat for the lows. Let's go out on the daily. We've definitely made really good progress here on attacking this dollar index. It's definitely reverse trend there. Let's see if we can keep it up. We really want to see this come down. How does this event affect the Santa rally that all the YouTube channels with the screaming faces kept predicting? Yeah, good question. I think the real driver to the Santa rally was the CPI results. That was the big green light. This is just, you know, we got as what we were expecting. You know, it was as forecast, so I believe the rates decision was kind of already priced in. I think this was just a pump for the sake of it, like a buy the rumor, sell the news type move. So if you did buy like inside this consolidation area and you sold at the highs here, then hey, that's awesome. That's a good little play there. I mean, the percentage won't be that impressive, I don't think. 3.3. That's, I mean, for Bitcoin, that's a good thing. 3.4%. Not bad at all. So, you know, there could be some interesting little nuggets that excite the market again in the actual meeting that's coming up now. So let me bring that little list back up. So we've had the rates decision now at 5:30. We've got the press conference. Now that'll probably go for like an hour, I would say. And then for the rest of the day, there's 3 other key high impact events here: core retail sales, Empire State Manufacturing Index, and then the retail sales. So we've got the forecasts there, and we'll see what figures come in for that. But yeah, that's today's a little bit of excitement in the markets based around these events. So I'm going to go back to that FOMC page there, and we'll see if I'll find it. So it's on the Federal Reserve's YouTube channel. So if you are wanting to watch it, by all means you can go check it out. Don't feel like you have to stay here. That's all good. That starts at 2:30, which is 10 minutes away. I think I'm gonna listen to it while the chart's going. Just listen to what he says. I'll turn the music off at that time, but for now, just gonna relax and wait for that moment. So it feels like perhaps, you know, the equilibrium here that we're working with here is somewhere like this, around this zone. This was like the build up and anticipation from the rate. The sell-off, this is the sell the news. So a buy the rumor, sell the news event is not CPI, usually. It's a rate decision. So if you think about it like Dogecoin, with the SNL, when Elon Musk went on SNL, everyone sort of built, like, you know, bought in anticipation, you know, buy the rumor. And then as soon as the event happens, it's a huge sell. So that's a buy the rumor, sell the news type event. I don't think CPI is more of like a sentiment driver, like a long-term sentiment driver, because, you know, the effect of it lasts for a month, basically, until we get the next report on CPI. So that's the way I see it anyway. You can also look back at last month when Pump Papa Pal starts to say the words. Yeah, there you go. Zorana says, don't forget the take profit area from the original announcement of the 0.5. Yeah. This is definitely, I guess now we sort of know, leading up to the data or the funds rate decision, it's good to sort of like get out of the position before the release. So, you know, even if you got out through here, which was, you know, a good 10 minutes before the decision came out, because you don't want to, like, it's probably better not to be in a position during all of this volatility, like this uncertainty. You want to basically ride the hype train. That seems to be what the takeaway from this, for me at least. You know, buy the anticipation and then sell before the actual event starts, so that you're at least locking in whatever gains you made on the way up in anticipation to the fund rate decision. But yeah, this, okay, dollar index I'm guessing is still climbing. Let's go to that. Yeah. There's your dollar index. S&P, bit of a tumble there. So let's open up the SPY, because I think that market's still moving right now. Now, where was the open for the SPY? It was here, this big green candle here. So it's been an interesting day. We've come up, made a cup, and then collapsed. What a day. We turn session breaks on, you'll see the cut of the day. So the day before was pretty interesting. There was a huge gap up, as we all know. This big gap. And that gap, the whole day was spent filling that gap, or half the day. And then we sort of bounced and started trying to recover some of that progress. And then, yeah, today has been, you know, a continuation of that progress hike. Look at where the resistance came in. Just could not break back into that that rising wedge, you know, this big old rising wedge that we've been in for the S&P. So we've fallen out of it, we've back tested it, and we've been rejected. So, you know, we're back into the macro falling wedge. Now, the good thing about a falling wedge is that it's a bullish pattern, so don't be too worried about it. There may be a leg down that we have to deal with, but I don't know. Look, we'll see what happens. We've still got Thursday and Friday this week left of trading for the stock exchange. So 2 more weekdays to go until the weekend. Now the weekend, as we know, stock market is down for that time over the weekend, and that usually sends crypto into a hibernation. Not too much happens in crypto, at least recently, during the weekends. It goes super flat. And we saw some of that back here. This was our weekend right here, I believe. Flat and boring. But yeah, let's see. Hopefully the next 2 days, like, we get some interesting moves on the S&P. It looks like it might want to drop, just because we've had this really obvious and harsh rejection by the trend line here. But hey, who knows? Who knows? Nothing I say is advice or a perfect prediction of the future. It's just speculation. So take it with a grain of salt. It's just my opinion. Trade at your own risk. You do you, as Piskett says. Now let's go back to the minute chart here. I'm trying to establish support at some particular level. Let me look at these wicks back into these these lows, these prior lows here. That was a very heavy move down. Let's measure that. So from the high, if you had opened a short down to the drop here, that was a very quick 3.4%. You know, in the space of what, 5 minutes? Within 5 minutes? Yeah, 5 minutes, 3.4%. That's a lot of movement on Bitcoin in such a short time. Yeah. Very cool. So we've got 2 minutes to go now until the meeting. So let me turn that down. We'll turn this up. Here we go. Papa Pal's coming out. Give us some good news, Papa Pal. Pump Poppy Pal.
Good afternoon. Before I go into the details of today's meeting, I'd like to underscore for the American people that we understand the hardship that high inflation is causing and that we are strongly committed to bringing inflation back down to our 2% goal. Over the course of the year, we've taken forceful actions to tighten the stance of monetary policy. We've covered a lot of ground, and the full effects of our rapid tightening so far are yet to be felt. Even so, we have more work to do. Price stability is the responsibility of the Federal Reserve and serves as the bedrock of our economy. Without price stability, the economy doesn't work for anyone. In particular, without price stability, we will not achieve a sustained period of strong labor market conditions that benefit all. Today, the FOMC raised our policy interest rate by a half percentage point. We continue to anticipate that ongoing increases will be appropriate in order to attain a stance of monetary policy that is sufficiently restrictive to return inflation to 2% over time. In addition, we're continuing the process of significantly reducing the size of our balance sheet. Restoring price stability will likely require maintaining a restrictive policy stance for some time. I'll have more to say about today's monetary policy actions after briefly reviewing economic developments. The U.S. economy has slowed significantly from last year's rapid pace. Although real GDP rose at a pace of 2.9% last quarter, it is roughly unchanged through the first 3 quarters of this year. Recent indicators point to modest growth of spending and production this quarter. Growth in consumer spending has slowed from last year's rapid pace, in part reflecting lower real disposable income and tighter financial conditions. Activity in the housing sector has weakened significantly, largely reflecting higher mortgage rates. Higher interest rates and slower output growth also appear to be weighing on business fixed investment. As shown in our summary of economic projections, the median projection for real GDP growth stands at just 0.5% this year and next, well below the median estimate of the longer-run normal growth rate. Despite the slowdown in growth, the labor market remains extremely tight, with the unemployment rate near a 50-year low, job vacancies still very high, and wage growth elevated. Job gains have been robust, with employment rising by an average of 272,000 jobs per month over the last 3 months. Although job vacancies have moved below their highs and the pace of job gains has slowed from earlier in the year, the labor market continues to be out of balance, with demand substantially exceeding the supply of available workers. The labor force participation rate is little changed since the beginning of the year. FOMC participants expect supply and demand conditions in the labor market to come into better balance over time, easing upward pressures on wages and prices. The median projection in the SEP for the unemployment rate rises to 4.6% at the end of next year. Inflation remains well above our longer-run goal of 2%. Over the 12 months ending in October, total PCE prices rose 6%. Excluding the volatile food and energy categories, core PCE prices rose 5%. In November, the 12-month change in the CPI was 7.1%, and the change in the core CPI was 6%. The inflation data received so far for October and November show a welcome reduction in the monthly pace of price increases. But it will take substantially more evidence to give confidence that inflation is on a sustained downward path. Price pressures remain evident across a broad range of goods and services. Russia's war against Ukraine has boosted prices for energy and food and has contributed to upward pressure on inflation. The median projection in the SEP for total PCE inflation is 5.6% this year and falls to 3.1% next year, 2.5% in 2024, and 2.1% in 2025. Participants continue to see risks to inflation as weighted to the upside. Despite elevated inflation, longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. But that is not grounds for complacency. The longer the current bout of high inflation continues, the greater the chance that expectations of higher inflation will become entrenched. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. We are highly attentive to the risks that high inflation poses to both sides of our mandate, and we are strongly committed to returning inflation to our 2% objective. At today's meeting, the committee raised the target range for the federal funds rate by a half percentage point, bringing the target range to 4.25% to 4.5%. And we are continuing the process of significantly reducing the size of our balance sheet. With today's action, we have raised interest rates by 4.25 percentage points this year. We continue to anticipate that ongoing increases in the target range for the federal funds rate will be appropriate in order to attain a stance of monetary policy that is sufficiently restrictive to return inflation to 2% over time. Over the course of the year, financial conditions have tightened significantly in response to our policy actions. Financial conditions fluctuate in the short term in response to many factors, but it is important that over time they reflect the policy restraint that we're putting in place to return inflation to 2%. We are seeing the effects on demand in the most interest-sensitive sectors of the economy, such as housing. It will take time, however, for the full effects of monetary restraint to be realized, especially on inflation. In light of the cumulative tightening of monetary policy and the lags with which monetary policy affects economic activity and inflation, the committee decided to raise interest rates by 50 basis points today, a step down from the 75 basis point pace seen over the previous 4 meetings. Of course, 50 basis points is still a historically large increase, and we still have some ways to go. As shown in the SEP, the median projection for the appropriate level of the federal funds rate is 5.1% at the end of next year, a half percentage point higher than projected in September. The median projection is 4.1% at the end of 2024 and 3.1% at the end of 2025, still above the median estimate of its longer run value. Of course, these projections do not represent a committee decision or plan, and no one knows with any certainty where the economy will be a year or more from now. Our decisions will depend on the totality of incoming data and their implications for the outlook for economic activity and inflation. And we will continue to make our decisions meeting by meeting and communicate our thinking as clearly as possible. We are taking forceful steps to moderate demand so that it comes into better alignment with supply. Our overarching focus is using our tools to bring inflation back down to our 2% goal and to keep longer-term inflation expectations well anchored. Reducing inflation is likely to require a sustained period of below-trend growth and some softening of labor market conditions. Restoring price stability is essential to set the stage for achieving maximum employment and stable prices over the long run. The historical record cautions strongly against prematurely loosening policy. We will stay the course until the job is done. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I will look forward to your questions.
Steve Leisman, CNBC. Thanks for taking my question, Mr. Chairman. You just talked about the importance of market conditions reflecting the policy restraint you put in place. Since the November meeting, the 10-year has declined by 60 basis points. Mortgage rates have come down. High-yield credit spreads have come in. The economy's accelerated, and the stock market's up 6%. Is this loosening of financial conditions a problem for the Fed in its effort and its fight against inflation? And if so, do you need to do something about that, and how would you do something about that? Thank you.
So as I mentioned, it is important that overall financial conditions continue to reflect the policy restraint that we're putting in place to bring inflation down to 2%. We think that financial conditions have tightened significantly in the past year, but our policy actions work through financial conditions, and those in turn affect economic activity, the labor market, and inflation. So what we control is our policy moves and the communications that we make. Financial conditions both anticipate and react to our actions. I would add that our focus is not on short-term moves, but on persistent moves, and many things, of course, move financial conditions over time. I would say it's our judgment today that we're not at a sufficiently restrictive policy stance yet, which is why we say that we would expect that ongoing hikes would be appropriate. And I would point you to the SEP, again, for our current assessment of what that peak level will be. As you will have seen, 19 people filled out the SEP this time, and 17 of those 19 wrote down a peak rate of 5% or more, in the fives. So that's our best assessment today for what we think the peak rate will be. You will also know that at each subsequent SEP during the course of this year, we've actually increased our estimate of what that peak rate will be. And today, the SEP that we're published shows that, again, that overwhelmingly FOMC participants believe that inflation risks are to the upside. So I can't tell you confidently that we won't move up our estimate of the peak rate again at the next SEP. I don't know what we'll do. It will depend on future data. What we're writing down today is our best estimate of what we think that peak rate will be based on what we know. Obviously, if the inflation data come in worse, that could move up, and it could move down if inflation data are softer.
Gina.
Gina Smilik, New York Times. Thanks for taking our questions. The SEP, like you mentioned, suggests that the Fed will be making another 3/4 percentage points worth of rate increases in 2023. I wonder if you would foresee that being in 25 basis point increments, 50 basis point increments, sort of how you see the speed playing out going forward. And then I wonder what you're looking at as you determine when to stop.
Yeah. As I've been saying, as we've gone through the course of this year, as we lifted off and got into the course of the year, and we saw how strong inflation was and how persistent, it was very important to move quickly. In fact, the speed, the pace with which we were moving was the most important thing. I think now that we're coming to the end of this year, we've raised 425 basis points this year, and we're into restrictive territory. It's now not so important how fast we go. It's far more important to think, what is the ultimate level? And then at a certain point, the question will become, how long do we remain restrictive? That will become the most important question. But I would say the most important question now is no longer the speed. So, and that applies to February as well. So I think we'll make the February decision based on the incoming data and where we see financial conditions, where we see the economy. And that'll be the key thing. But for that decision. But ultimately, that question about how high to raise rates is going to be one that we make looking at our progress on inflation, looking at where financial conditions are, and making an assessment of whether policy is restrictive enough. I've told you today we have an assessment that we're not at a restrictive enough stance, even with today's move, and we've laid out our individual assessments of what we would need to do to get there. At a certain point, though, we'll get to that point, and then the question will be, how long do we stay there? And the strong view on the committee is that we'll need to stay there, until we're really confident that inflation's coming down in a sustained way, and we think that will be some time. Now, why do I say that? If you look at you can break inflation down into three sort of buckets. The first is goods inflation, and we see now, as we've been expecting really for a year and a half, that supply conditions would get better, and ultimately supply chains get fixed, and demand settles down a little bit and maybe goes back to services a little bit, and we start to see goods inflation coming down. We're now starting to see that in this report and the last one. Then you go to housing services. We know the story there is that housing services inflation has been very, very high and will continue to go up, actually, as rents expire and have to be renewed. They're going to be renewed into a market where rates are higher than they were when the original leases were signed. But we see that the new leases that the rate for new leases is coming down. So once we work our way through that backlog, that inflation will come down sometime next year. The third piece, which is something like 55% of the index, PCE core inflation index, is non-housing related core services, and that's really a function of the labor market largely. The biggest cost by far in that sector is labor, and we do see a very, very strong labor market, one where we haven't seen much softening, where job growth is very high, where wages are very high, vacancies are quite elevated, and really there's an imbalance in the labor market between supply and demand. So that part of it, which is the biggest part, is likely to take a substantial period to get down. The goods inflation has turned pretty quickly now, after not turning at all for a year and a half. Now it seems to be turning. But there's an expectation, really, that the services inflation will not move down so quickly, so that we'll have to stay at it, so that we may have to raise rates higher to get to where we want to go. And that's really why we are writing down those high rates, and why we're expecting that they'll have to remain high for a time.
Howard Schneider with Reuters. Thanks for taking the question. You described GDP growth in the SEPs as moderate or modest, I believe, yet it's really approaching stall speed. Half a percentage point is not much. You described labor market unemployment rate as representing some softening, but it's nearly a full percentage point rise, and that's well in excess of what has historically been associated with recession. Why wouldn't this be considered a recessionary projection by the Fed?
Well, I'll tell you what the projection is. I don't think it would qualify as a recession, no, because you've got positive growth. The expectations in the SEP are basically, as you said, which is we've got growth at a modest level, which is to say about a half a percentage point. That's positive growth. It's slow growth. It's well below trend. It's not going to feel like a boom. It's going to feel like very slow growth, right? In that condition, labor market conditions are softening a bit. Unemployment does go up a bit. I would say that many analysts believe that the natural rate of unemployment is actually elevated at this moment. So it's not clear that those forecasts of inflation are really much above the natural rate of unemployment. We can never identify its location with great precision. But that 4.7% is still a strong labor market. If you look, you've got the reports we get from the field are that companies are very reluctant to lay people off, other than the tech companies, which is a story unto itself. Generally, companies want to hold on to the workers they have because it's been very, very hard to hire. So, and you've got all these vacancies out there far in excess of the number of employed people. That doesn't sound like a labor market where a lot of people will need to be put out of work. So that there are channels through which the labor market can come back into balance with relatively modest increases in unemployment, we believe. None of that is guaranteed, but that is what their forecast reflects.
Nick.
Thanks, Nick Tamaros of the Wall Street Journal. Chair Powell, I want to follow up on Gina's question. The decision to step down the pace of rate rises appears to have been socialized at your last meeting, largely before the past two CPI reports showed inflation decelerating in line with the committee's forecast this year. You just now talked about making decisions meeting by meeting and being mindful of the lags of policy. Does that mean, all things equal, you would feel more comfortable probing where the terminal rate is by moving in 25 basis point increments, including beginning at your next meeting?
So I haven't made a judgment on what size rate hike to make at the last meeting. But what you said is broadly right, which is having moved so quickly and having now so much restraint that's still in the pipeline, we think that the appropriate thing to do now is to move to a slower pace. And that will allow us to feel our way and and get to that level, we think, and better balance the risks that we face. So that's the idea. It makes a lot of sense, it seems to me, particularly if you consider how far we've come. But again, I can't tell you today what the actual size of that will be. It will depend on a variety of factors, including the incoming data in particular, the state of the economy, the state of financial conditions.
With the CPI report, if it had come out last week, do you think it would have changed some of those forecasts in today's SEP?
No, absolutely not. No, as just a matter of practice, the SEP reflects any data that comes out during the meeting, and participants know that that they can make changes to their SEP during the meeting, well in advance of the press conference, so that we're not running around. But that's not the case. It's never the case that the SEPs don't reflect an important piece of data that came in on the first day of the meeting.
Thanks. Rachel?
Hi, Chair Powell. Rachel Siegel from the Washington Post. Thank you for taking our questions. I'm wondering if we could talk about the projection for the unemployment rate. Why has the Fed raised its unemployment projection? Is it because the models suggest that a higher terminal rate would automatically cause a higher unemployment rate? Or are you seeing signs that the labor market isn't quite as strong as we think it is now? Thanks.
No, it's not about the strength of the labor market. The labor market is clearly very strong. It is more just that, by now, we've continually expected to make faster progress on inflation than we have ultimately, and that's why the peak rate for this year goes up between this meeting and the September meeting, you see that you see the fact that we've made less progress than expected on inflation. So that's why that goes up, and that's why unemployment goes up, because we're having to tighten policy more. And so it didn't go up by much in the meeting, I don't think, but that's the idea, is slower progress on inflation, tighter policy, probably higher rates, probably held for longer, just to get to where the kind of restriction that you need to get inflation down to 2%.
Do you have a sense of, in order to get to that number, how much of that could be caused by layoffs versus vacancies trimming or changes to the labor force population rate?
So it's very hard to say. You know, you can look at history, right? And history would say that in a situation like this, the declines in unemployment would be more meaningful, I think, than what you see written down there. But why do we think that is the case? So I'll give you a few reasons. First, just is that there's this huge overhang of vacancies, meaning that vacancies can come down a fair amount, and we're hearing from many companies that they don't want to lay people off, so that they'll keep people because it's been so hard. I mean, I think it feels like we have a structural labor shortage out there, where there are 4 million fewer people, a little more than 4 million, who are in the workforce available to work than there's demand for workforce. So the fact that there's a strong labor market, means that companies will hold on to workers, and it means that it may take longer, but it also means that the costs in unemployment may be less. Again, that we're going to find out empirically, but I think that's a reasonably possible outcome, and you do hear many labor economists believe that it is. So we'll see, though.
Colby?
Thank you. Colby Smith with the Financial Times. How should we interpret the higher core inflation forecast for 2023 in the SEP? Does that not then suggest that the policy rate currently forecasted for next year should actually be higher than the 5.1 medium estimate penciled in?
Well, I think that's why one of the reasons it went up was that core came in stronger this year. Yeah, what you see is our best estimate as of today, really, for how high we need to raise rates, to how much we need to tighten policy to create enough, restrictive policy to slow economic activity and soften the labor market and bring inflation down through those channels. That is the estimate, best estimate we make today. And as I mentioned, we'll make another estimate for the next SEP, and we'll, of course, between meetings we do the same thing, but we don't publish it.
Victoria?
Hi, Victoria Guida with Politico. I wanted to make sure I understand specifically what's going on in the SEP, because you all expect rates to go higher, but you're also more pessimistic about what inflation is going to look like next year. And I was just wondering, given that we have seen some cooling in inflation, is that primarily because of wage growth, that you expect wage growth to be sort of a headwind?
No, we're going into next year with higher inflation than we had thought. Right, so we're actually moving down to the level that we're moving down to next year is still a very large drop in inflation from where inflation is running now, well more than a 1% change in inflation. But remember that the jump-off point at the beginning of the year is higher. So we're moving down still by a very large chunk. I don't think the policy's having any less effect. It's just starting from a higher level at the end of 2022. So we're getting down. I believe the median is 3.5%. That's a pretty significant drop in inflation. And where's it coming from? It's coming from the goods sector, clearly. By the middle of next year, we should begin to see lower inflation from the housing services sector. And then, the big question is how much will you see from the largest, the 55% of the index, which is the non-housing services sector. And, that's where you need to see, we believe you need to see a better balancing of supply and demand in the labor market, so that you have, it's not that we don't want wage increases, we want strong wage increases, we just want them to be at a level that's consistent with 2% inflation. Right now, if you factor in productivity estimates, standard productivity estimates, wages are running, well above what would be consistent with 2% inflation.
Neil?
Thanks. Hi, Chair Powell. Neil Irwin with Axios. Some of your colleagues have been pretty explicit that they can't imagine rate cuts happening in 2023. That's certainly not implied by the SEP. But futures markets have priced in some easing in the back half of next year. What's your view of the likelihood of any kind of rate cuts next year? What circumstances might make that plausible?
You know, our focus right now is really on moving our policy stance to one that is restrictive enough to assure a return of inflation to our 2% goal over time. It's not on rate cuts. And we think that we'll have to maintain a restrictive stance of policy for some time. Historical experience cautions strongly against prematurely loosening policy. I guess I would say it this way. I wouldn't see us considering rate cuts until the committee is confident that inflation is moving down to 2% in a sustained way. So that's the test I would articulate. And you're correct. There are not rate cuts in the SEP for 2023.
Steve Matthews with Bloomberg. Let me ask you about China. In the last few weeks, China has abandoned its COVID policy and been reopening pretty strongly. I'm wondering if you see that as disinflationary because you're seeing supply chains improve, or inflationary because it obviously brings a lot more demand globally, improves the global outlook for growth and for commodities prices.
And so you're right. Those two things will offset each other. Weaker output in China will push down on commodity prices, but it could interfere with supply chains ultimately, and that could push inflation up in the West. It's very hard to say, you know, how those two will offset each other, and it doesn't seem likely actually that the overall net effect would be material on us. But to your point, China faces a very challenging situation in reopening. And we've seen waves of COVID all around the world can interfere with economic activity. China, a very critical manufacturing place for manufacturing and exporting. Their supply chain is very important. China faces a reopening. They've backed away from their COVID restriction policies. There could be very significant increases in COVID, and we'll just have to see. It's a risky situation. But again, it doesn't seem like it's likely to have material overall effects on us.
Chris.
Hi, Chris Rugaber at Associated Press. Thank you for taking my question. I wondered if you could comment a bit more about yesterday's inflation report. I mean, it showed inflation cooling in all three of the categories that you laid out at Brookings. Are you confident that you're seeing real progress on getting inflation under control? Are you still worried it could slip into some kind of unentrenched, upward spiral? Thank you.
Right. So the data that we've received so far for October and November, we don't have we have some remaining data to get in November, but they clearly do show a welcome reduction in the monthly pace of price increases. As I mentioned in my opening statement, it will take substantially more evidence to give confidence that inflation is on a sustained downward path. So the way we think about this is this. This report is very much in line with what we've been expecting and hoping for. And what it does is it provides greater confidence in our forecast of declining inflation. As I mentioned, we've been forecasting significant declines in overall inflation and core inflation in the coming year. And this is the kind of reading that it will take to support that. So really this gives us greater confidence in our forecast rather than at this point changing our forecast. In terms of the pieces, we have been expecting goods inflation to come down as supply chain pressures eased. That's happening now. Housing services, as I mentioned, there is good news in the pipeline as long as new housing leases show declining inflation. That will show up in the measure around the middle of next year, so that should help. And the big piece, again, is core services ex housing, which is very important, and we have a ways to go there. You do see some beginning signs there, but ultimately that's that more than half, as I mentioned, of PCE core index, and it's very fundamentally about the labor market and wages. If you look at wages, look at the average hourly earnings number we got with the last payrolls report. You don't really see much progress in terms of our average hourly earnings coming down. Now there may be composition effects and other effects in that, so we don't put too much weight on any one report. These things can be volatile month to month, but we'll be looking for wages moving, down to more normal levels where workers are doing well and ultimately their gains are not being eaten up by inflation.
Michael and Kate.
There's a
All right. The link to that stream is in the chat if you want to continue watching that. But yeah, that's pretty much it. I think we got the gist of this FOMC meeting. 4.5% interest rate is the current rate. They raised by 50 basis points as forecast. And yeah, it's been a bit of a buy the rumor, sell the news type event. But anyway, guys, thanks for tuning into this stream. I'm probably going to cut it there. There's an hour left of the market, so the S&P still got an hour left of trade before it closes for the day. And yeah, it looks like the dollar index has come straight back down, so that's a good thing. It kicked up, a bit of an anomaly there, kicked up, and then now it's come straight back down again. So maybe that'll give the permission for the S&P to rise back up again and attack these highs. But I don't know. We'll see. We'll see what happens there. If the S&P does well, Bitcoin does well. They seem to trade in tandem. Anyway, guys, yeah. Once again, thanks again for tuning in, and I'll catch you on the next stream. Cheers.